The history of the financial markets is dominated by professionals who spent their entire careers inside the closed ecosystem of Wall Street. They learned the game in brokerage houses, on the floors of the exchanges, and within the institutional framework that governed the flow of capital. Their worldview was shaped by the opinions, the rumors, and the groupthink of this insulated world. But occasionally an outsider appears, an individual so removed from this environment that they are forced to see the market not for what others say it is, but for what it truly is. A raw, unfiltered mechanism of supply and demand. Nicolas Darvas was the ultimate outsider. His story is not just a lesson in a powerful trading strategy. It is a testament to the profound advantage of independent thought and a definitive proof that the universal laws of the market are available to anyone with the discipline to observe them. His journey to the stock market was as improbable as his eventual success. Born in Hungary in 1920, Darvas was trained as an economist at the University of Budapest. His formal education, however, was violently interrupted by the Second World War. With the Nazis approaching from the west and the Soviets from the east, he fled his homeland with a forged visa and 50 British pounds to his name. He spent years as a refugee in Turkey, working odd jobs before finding his true calling in an unlikely profession: ballroom dancing. Partnering with his sister Julia, he displayed a talent so prodigious that they quickly became one of the most famous and highest-paid dance acts in the world, touring constantly and performing in the most exclusive venues across Europe and America. His life was a whirlwind of sold-out shows, international travel, and celebrity, a world utterly disconnected from the sober realm of finance. His entry into the stock market was a complete accident. In 1952, during an engagement at a nightclub in Toronto, the owners found themselves short on cash. As a partial payment for his performance, they offered him 6,000 shares of a Canadian mining company called Breakout, valued at 50 cents a share. Darvas, with no knowledge of or interest in stocks, reluctantly accepted. He promptly forgot about the shares, tucking the certificate away as he continued his globe-trotting dance career. It was only months later, while glancing at a newspaper, that he saw the name Breland quoted. To his astonishment, the stock he had acquired for 50 cents was now trading at $1.90. He sold immediately, turning his initial $3,000 stake into more than $11,000. This initial, effortless profit was the spark. It ignited his curiosity and set him on a path that would consume his life for the next 7 years. Believing he had discovered an easy path to wealth, Darvas plunged into the market with the blind confidence of a novice. He subscribed to advisory services, listened to the tips of brokers, and followed the rumors he heard from other investors. The result was predictable. He quickly lost his initial profits from Breland, and then some. This period of failure was the most critical juncture in his financial education. It taught him a powerful lesson. The advice of others, the so-called experts, was not only worthless but actively harmful. It was based on opinion, guesswork, and emotion, not on any rational or repeatable process. He realized that if he were to succeed, he would have to develop his own methods, based on his own observations and his own logic. This decision marked his transformation from a passive gambler into a serious, methodical market operator. This transformation was defined by two crucial factors: his obsessive dedication and his profound isolation. He turned his life on the road into a unique advantage. While his dance career took him from Paris to Tokyo, from London to Hong Kong, he was thousands of miles away from the noise and psychological contamination of Wall Street. He had no access to the trading floor gossip, the television pundits, or the daily deluge of conflicting opinions. His entire laboratory for studying the market consisted of 2 publications, which he had airmailed to him wherever he was in the world: Barron's and the Wall Street Journal. His only tools were the raw numbers printed on the page, the daily price and volume quotations. This isolation forced him into a state of pure objectivity. He began a period of intense, obsessive self-education, a process that would have broken a less determined man. He described his approach as a scientific endeavor, dedicating every spare moment to his new passion. During his off hours as a dancer, he launched into a period of intense, obsessive self-education. He devoured some 200 books on the market and on the lives of past speculators, sometimes reading for up to 8 hours a day. He filled notebooks with charts he drew by hand, studying the behavior of thousands of individual stocks. He tested countless theories, buying and selling small amounts to see what worked and what failed. He was not looking for tips. He was searching for universal principles, for repeatable patterns of behavior. Through this painstaking process of trial and error, he came to a foundational conclusion. The only truth in the market is the interplay of price and volume. Everything else is narrative. From this conclusion, he began to build a theoretical framework that would eventually become his famous system. Before Nicolas Darvas codified his box theory, he first had to understand the universal laws of market movements that make such a system possible. Through his independent research, he effectively rediscovered the foundational principles of technical analysis that had been identified by past masters. He learned to read the market as a narrative of human psychology, a constant battle between fear, hope, and greed as expressed through price and volume. He saw that before any stock could make a major upward move, it first had to go through a period of preparation, a phase of consolidation where the groundwork for the subsequent trend was laid. This period of consolidation is the fundamental building block of all breakout strategies. It represents a temporary state of equilibrium, an argument between buyers and sellers that has reached a stalemate. On a price chart, this appears as a period of sideways movement, contained within a definable range. The top of this range is resistance, a price level where sellers consistently emerge, overwhelming buyers and turning the price back down. This selling pressure comes from investors who bought at a lower price and are now content to take profits, and from those who bought at this level previously and are now desperate to sell and get their money back at break-even. The bottom of the range is support, a price level where buyers consistently emerge, absorbing all the selling pressure and turning the price back up. This demand comes from investors who missed the previous move and see the pullback as a buying opportunity, and from institutions that may be quietly accumulating a position. For days, weeks, or even months, the stock will trade within this channel, forming what traders call a base or a consolidation zone. Darvas would later call this a box. This zone is not a passive state. It is a period of immense energy compression. The longer the consolidation and the tighter the price range, the more powerful the eventual energy release is likely to be. However, price alone does not tell the whole story. Darvas, like all great technical analysts, understood the decisive role of volume. Volume is the fuel that powers a market move. It is the measure of conviction behind a price change. A stock that attempts to break out of a consolidation range on low volume is like a rocket trying to achieve orbit with insufficient thrust. It is likely to fail, falling back into the range as the weak buying is easily overcome by the residual supply of sellers. This is a false breakout, a classic trap for amateur traders. A true valid breakout, however, is almost always accompanied by a dramatic surge in volume, often 50% or more above its average daily turnover. This high volume is the unmistakable signature of institutional participation. It signals that large, informed market participants, mutual funds, pension funds, and other major players are aggressively buying the stock, absorbing all available supply and confirming that the balance of power has decisively shifted in favor of the buyers. This volume surge is the market's verdict, a loud announcement that the argument has been settled and a new trend has begun. While Darvas developed his theories in isolation, he was not the first to discover these principles. He was, in fact, standing on the shoulders of giants. The intellectual precursors to his system can be found in the work of the early 20th century's greatest market operators. The first is Richard Wyckoff, a legendary trader and educator who deconstructed market movements into a clear, institutional logic. Wyckoff proposed that all major trends are the result of campaigns orchestrated by large, informed operators whom he dubbed the Composite Man. He developed detailed schematics showing how this composite man would patiently accumulate a large position in a stock during a long consolidation phase, a process he called the accumulation phase. This phase is characterized by the absorption of shares from weak hands, often involving tests of support and shakeouts to frighten smaller players into selling. The box that Darvas later identified is often the final stage of a long Wyckoff accumulation, the springboard from which the stock makes its jump across the creek and begins its new uptrend or markup phase. Wyckoff's work provides the underlying institutional logic for why breakout patterns form and why they are so powerful. The second and more direct intellectual ancestor to Darvas's method is Jesse Livermore. While a pure speculator, Livermore's entire methodology was based on identifying and exploiting what he called pivotal points, a concept that is fundamentally a breakout strategy. Like Darvas, Livermore believed that the most profitable and, paradoxically, the safest time to buy a stock was not when it was dormant or declining, but at the precise moment it was demonstrating undeniable strength by breaking out into new high ground. He wrote, "The stock is telling you a story. The story of a stock that is acting right, breaking into a new high, is the one I want to hear." He would wait for a stock to emerge from a long period of consolidation and would place his initial buy order only after it had decisively cleared that old resistance level. This breakout was the market's confirmation that the line of least resistance was now upward. Livermore's principles of buying strength, waiting for confirmation, and identifying these critical breakout points are the philosophical foundation upon which Darvas, whether consciously or not, would later build his entire mechanical system. Before Darvas created his boxes, the raw psychology of market movements was best captured by the era's greatest speculator, Jesse Livermore. To understand that emotional side of the market, the fear and greed that create the very patterns Darvas sought to exploit, the foundational text is Edwin Lefebvre's Reminiscences of a Stock Operator. This book is essential for learning about the speculative chaos that a disciplined system is designed to filter out. To help you absorb its timeless lessons, we have linked in the description a unique chapter-by-chapter analysis by Max Davidson, specifically designed for the modern reader. By combining the institutional logic of Wyckoff with the tactical execution of Livermore, we arrive at the theoretical basis for breakout trading. It is a strategy predicated on the idea that periods of price consolidation represent a buildup of energy, and that a breakout on high volume is the release of that energy, signaling the start of a new, sustainable trend. Darvas's genius was not in inventing these principles, but in observing them independently and, more importantly, in systematizing them into a rigid, mechanical set of rules that could be executed with perfect discipline, free from the emotional turmoil that had destroyed so many operators before him. He had discovered the universal laws of market motion. The next step was to build a machine to exploit them. The first step in building any successful system is building the habit of disciplined study and observation. The principles discussed here are not abstract theories. They are the foundational laws of market behavior. Mastering them requires reinforcement and a commitment to lifelong learning. If you are serious about developing the habits necessary for success, subscribe to this channel and click the notification bell. Let this be the place you come to forge the intellectual framework that will define your future in the markets. In part 2 of this analysis, we will deconstruct the precise mechanics of the Darvas box system and examine, step by step, how he used this framework to turn a small stake into a multi-million-dollar fortune in just 18 months. The universal laws of market motion, the anatomy of consolidations, the role of volume, and the principles of trend provided Nicolas Darvas with a theoretical foundation. But theory alone does not build fortunes. The critical step that separated Darvas from thousands of other market students was his ability to synthesize these observations into a complete, mechanical, and ruthlessly efficient operational system. He understood that a successful strategy required two distinct components. First, a rigorous method for selecting the right kind of stocks, and second, an unemotional set of rules for managing the trades. This dual filter approach, which he termed his techno-fundamental theory, was the engine of his entire operation. It was a system designed by an outsider for an outsider, and it would soon prove its profound effectiveness. The first filter of his system was his unique approach to stock selection, a method that stood in stark contrast to the prevailing wisdom of his time. Darvas was not a pure technician or chartist who believed that the price chart was the only thing that mattered. He was equally not a traditional fundamental analyst who pored over balance sheets in search of hidden value. Instead, he fused the two disciplines. His fundamental analysis was not concerned with finding statistically cheap stocks. It was concerned with identifying companies at the epicenter of explosive industrial and technological growth. He reasoned that the truly massive multi-100% price moves, the kind that could turn a small stake into a fortune, were never found in stagnant, mature industries. They were found in companies that were fundamentally changing the world and, as a result, were experiencing dramatic and often accelerating growth in their earnings. The stock price, he believed, was ultimately a slave to earnings. His process was top-down and highly selective. He began by identifying the most promising industries of his era, the late 1950s. He was drawn to sectors brimming with innovation and capturing the public's imagination: electronics, aviation, advanced materials, and rocketry. He understood that these were the fields where new fortunes would be made. Within these leading industries, he then screened for the leading stocks. He would meticulously scan the weekly stock lists in Barron's, looking for companies that were consistently making new 52-week highs. This practice directly contradicted the buy low, sell high mantra often preached to the public. Darvas believed the opposite was true. A stock making a new high was a sign of immense strength, institutional demand, and a powerful underlying business story. He considered stocks trading at their lows to be sick and avoided them at all costs. He wanted the strongest stocks in the strongest industries. This combination of a powerful fundamental narrative, explosive earnings in a leading industry, and a powerful technical picture, a stock hitting new highs, was the core of his techno-fundamental filter. Only a stock that passed both of these tests would even be considered for the second stage of his analysis, the application of his box theory. The Darvas box system was the mechanical core of his entire strategy. It was a complete, self-contained set of rules for trade entry, risk management, and profit-taking. Its primary purpose was to remove all elements of human emotion: fear, hope, greed, and guesswork from the trading process. Darvas, the logical economist, sought to build a machine for extracting profits from the market, and the box theory was its intricate design. The first step was the precise definition of a box. A box was simply a price consolidation that occurred after a significant upward move. Its borders were defined by the recent price action. The top of the box, or the ceiling, was the highest price the stock had reached during its most recent advance. The bottom of the box, or the floor, was the lowest price it had fallen to during the subsequent consolidation. To ensure that the box was a legitimate period of equilibrium and not just random daily volatility, Darvas applied a simple time-based filter. He required that the stock trade within this price range for at least 3 consecutive days. Once a stock had established a clear ceiling and floor and remained within them, a box was officially drawn. This box represented a new temporary area of agreement between buyers and sellers, a pause in the uptrend while the stock digested its recent gains. The second component of the system was the entry rule. This was perhaps the most critical element, as it was designed to be purely automatic and unemotional. Darvas would never buy a stock while it was trading quietly inside a box. He was not interested in predicting which way it would go. He demanded that the stock prove its strength to him. He achieved this by using a buy-stop order. He would place an order with his broker, often via telegram from a distant city, to automatically buy the stock if, and only if, it traded just above the top of its established box. For example, if a box had a ceiling of $50, he would place his buy-stop order at $50 1/8. This ensured he was only entering a position at the exact moment of a confirmed breakout, the point where demand had demonstrably overwhelmed supply. He did not need to be watching the market. His order was his silent proxy, executing his logic with perfect, unemotional precision. The third and arguably most ingenious component was his risk management and profit-taking rule. This was the mechanism that allowed him to let his winners run to their full potential while ruthlessly cutting his losses. Upon entering a trade, his initial stop loss was placed just below the breakout price. This was a very tight stop designed to immediately exit a trade that failed to follow through, a false breakout. However, once the stock began to move significantly in his favor and formed a new higher box, he would cancel his old stop-loss order. He would then place a new one just below the floor of this new box. This is the secret to his famous trailing stop method. As the stock continued its ascent, building a staircase of higher and higher boxes, he would simply trail his stop-loss order up, moving it to the floor of the latest box each time a new one was established. This systematic process achieved two critical objectives. First, it relentlessly protected his profits. With each new box, a larger portion of his paper gain was locked in. Second, it forced him to stay in a winning trade for the duration of the major trend. He had no opinion on when a stock was too high. The stock itself had to tell him the trend was over by decisively breaking down and violating the floor of its most recent consolidation box. This is how he rode stocks like Texas Instruments for hundreds of points, immune to the scary headlines and minor pullbacks that would have shaken a discretionary trader out of the position. The final element of his system was a conservative approach to pyramiding. While he sometimes added to a position on a breakout from a subsequent box, he did so with a smaller amount of capital than his initial trade. His primary focus was on establishing a core position at the initial breakout and then protecting it as it grew. This entire system, the Techno-fundamental filter, the precise box definition, the automated entry, and the trailing stop, was a complete logical machine designed to identify and exploit the market's most powerful trends. The 18-month period from mid-1957 to the end of 1958 was when Darvas perfected this system and deployed it with spectacular results. This was the legendary run referenced on the video's thumbnail, a period in which he turned a capital base of approximately $36,000 into $2,450,000. This was not the result of one lucky trade, but of the systematic application of his method to a series of market leaders during a powerful bull market. Two of his most famous trades perfectly illustrate his system in action. The first was with Texas Instruments. In the late 1950s, the company was at the forefront of the semiconductor revolution, a leading industry by any measure. Its earnings were growing at an explosive rate. It passed his Techno-fundamental filter with flying colors. Darvas began to track the stock, watching as it formed a series of orderly boxes. He bought his initial position on a breakout and began to apply his trailing stop methodology. As the stock soared, it would pause, consolidate, and form a new, higher box. Each time he would patiently wait, and as it broke out of the new box, he would move his stop-loss up to the floor of that new consolidation. The stock embarked on a massive multi-month ascent, climbing from under $100 to over $400 a share. During this period, there were numerous pullbacks and scary news events that would have caused most traders to sell. But Darvas, isolated in his hotel rooms across the world, had only his rules. As long as the stock did not violate the floor of its latest box, he had no reason to sell. His system forced him to ride the trend to its conclusion, capturing a colossal profit. An even more dramatic case study was his trade in E.L. Bruce Company, a relatively obscure hardwood flooring manufacturer. The company passed his fundamental screen because it had developed a revolutionary new pre-finishing method that was causing its earnings to explode. The stock began to move. It formed a box, and Darvas bought the breakout. The trade was immediately successful, and the stock began to form a series of higher and higher boxes with breathtaking speed. The move was so violent that it attracted the attention of short sellers, and eventually the New York Stock Exchange itself, which launched an investigation and imposed trading halts. The stock became a battleground with wild, volatile price swings. A discretionary trader would have been paralyzed by fear and uncertainty, constantly second-guessing their position. But Darvas was insulated from this emotional storm by his system. His only question was simple. Has the stock violated the floor of its most recent box? As long as the answer was no, he did nothing. He held his position through the volatility, the investigations, and the frightening headlines. His trailing stop-loss, methodically moved up from box to box, kept him in the trade. Eventually, the trend exhausted itself, and the stock finally broke down, triggering his automatic sell order and handing him one of the largest profits of his career. The E.L. Bruce trade was the ultimate testament to his method. It proved that a simple, mechanical set of rules, when followed with iron-willed discipline, could successfully navigate even the most chaotic and emotionally charged market events. The legacy of Nicolas Darvas is a powerful and enduring one. He proved that success in the market is not the exclusive domain of Wall Street insiders. His story is a testament to the power of independent thought and the development of a logical, repeatable process. His success can be attributed to three core pillars. First was his isolation. By being thousands of miles away from the market's emotional center, he was protected from the rumors, opinions, and fear that plague most investors. This forced him to be objective. Second was his dual filter system. He did not just buy charts. He bought fundamentally strong companies in leading industries that were also showing immense technical strength. This combination of what to buy and when to buy was the engine of his method. Third, and most important, was his iron-willed discipline. His commitment to his mechanical rules for entry and, crucially, for exit was absolute. He subordinated his own ego and emotions to the logic of his system. In today's high-speed, information-overloaded market, Darvas's principles are more relevant than ever. His focus on objective price action, his use of automated orders to enforce discipline, and his strategy of filtering out the noise of daily opinion offer a powerful blueprint for any modern trader. The Darvas box theory is the foundation for countless modern breakout strategies, and his trailing stop methodology remains one of the most effective techniques for maximizing profits from a winning trade. Nicolas Darvas was the ultimate outsider who, through intense study, logical deduction, and superhuman discipline, proved that the market was not an unsolvable mystery, but a puzzle that could be solved.